I love that pie chart that Taylor showed, because it's so which stocks are cheap compared to actually having stable earnings and actually not having horrible earnings estimates revisions.
Absolutely. I mean, it's really interesting because if you look at this, cyclicals are cheap, defensives are expensive. The market is pricing in either a pretty significant downturn in earnings or even a recession. And I think what's interesting is if you look at some of the sectors with the healthiest beat ratio, they're industrials, tech. I mean, and then what's even more interesting is that companies that are missing earnings in industrials and tech are still outperforming the market. So I think a lot of this tells us that positioning in those sectors was super light coming into this year. I mean, like cyclicals were basically left for dead by the end of December and have done quite well.
True. That's reversed in the last month. Industrials are the best performer, up about 7% in the S&P. Tech up about almost 7% in the S&P as well. So does that rotation continue?
So I think it depends on March 1.
Oh, back to trade.
I know, back to the binary event of trade. But I really think that, you know, some of these sectors are essentially pricing in a more benign trade resolution. And if we don't get that, and I think there's a slim chance that trade talk gets even more negative than it has been. I think that we see some form of resolution. But if we don't, I think those sectors could take it on the chin.
So earnings are necessarily backward looking. It's what happens in the past. Let's look forward a little bit in sense of what people are doing right now. Are you seeing companies respond to this sort of defensive move in what they're doing with their cash? That is, for example, reducing their leverage as opposed to going out and buying things.
Right. You know, it's interesting that you point that out, because one thing that we noticed in the fourth quarter and so far in the first quarter that was surprising is that debt pay downs have actually stopped. In fact, we're seeing companies positive on net issuance, which is interesting because you'd think that in the face of the Fed and rising interest rates, et cetera, they would be really kind of focused on their balance sheets. And then we've seen actually M&A activity tick up quite significantly. So I think what's happening is less CapEx, less share buybacks have been relatively healthy, but less pay down of debt and more M&A, kind of bolt-on growth rather than building within.
But does that suggest that the CEOs, as they look out over the horizon, see some hope that demand will pick up? I mean, if they're really going into M&A and not paying down their debt, that would suggest they think it's coming.
Yeah, I mean, I think you're right, and I think also valuations of stocks have gotten to a point where M&A actually makes sense. So there are opportunities to buy at attractive valuations today. But I think the debt story is a big deal, not so much for the S&P 500, but for smaller companies. So, for example, if you look at small stocks, they're sitting on record levels of debt. That could become an issue going forward.